Welcome to the Explainer. Okay, there's a massive tax overhaul heading our way in 2026, and you're probably wondering what it means for the money you send to the IRS. So today, we are going to break down exactly what this new law means for your wallet.
So you might be asking, why a whole new law right now? Well, it turns out we were heading for what's called a tax cliff at the end of 2025. I mean, a really big one. If nothing was done, millions of us would have seen our taxes go up automatically. Let's dig into what Congress did to slam on the brakes.
All right, so the law has a pretty memorable name. It's called the One Big Beautiful Bill Act, and its main job? To stop that massive automatic tax hike dead in its tracks. Basically, it's taking the big ideas from the 2017 Tax Cuts and Jobs Act and trying to make them stick around for good.
See, that 2017 law had this built-in expiration date, a sunset provision. It meant that a bunch of popular tax cuts were just set to, poof, disappear. If lawmakers just sat on their hands, tax rates would have shot up, the standard deduction would have gotten smaller, and the estate tax exemption slashed in half. This new bill stops all that from happening. So let's kick things off with one of the most important pieces of the puzzle, the tax brackets.
Okay, so before we can really get a handle on these new tax brackets, we've got to talk about this sneaky little thing that happens every year. It's called bracket creep, and it can really mess with your paycheck if you're not paying attention. So what in the world is bracket creep? All right, picture this. You get a cost of living raise. Your paycheck looks bigger, right? But your actual buying power, the amount of stuff you can buy, hasn't changed at all because of inflation. Well, bracket creep is when that bigger but not really bigger paycheck pushes you into a higher tax bracket. Suddenly, you're paying more in taxes even though you're not actually any richer. It's a real bummer.
Okay, so to fight this bracket creep problem, the IRS has widened the income thresholds for 2026. Just take a look at this chart for married couples. You can see the income ranges for each tax rate are, well, they're bigger. For example, that 12% bracket, it used to stop at about 97 grand. Now you can earn all the way up to $100,800 before your next dollar gets hit with a higher tax rate.
You know, this brings up one of the biggest myths about taxes. A lot of people think that if you get a raise and it bumps you into a new tax bracket, suddenly all of your money gets taxed at that higher rate. No way. That is absolutely not how it works. We have what's called a progressive tax system here in the US, and honestly, it's way easier to understand than it sounds. Here's the best way to think about it. Imagine your income is like water, and the tax brackets are a series of buckets. So let's say we have a married couple making $150,000. First, you take out the standard deduction. Then, the first bit of their taxable income fills up the 10% bucket. Once that's full, the money spills over into the 12% bucket, and so on. It's only the money that fills that very last tippy-top bucket that gets taxed at your highest rate, not your whole income. Huge difference.
And hey, speaking of that deduction, let's actually talk about the standard deduction. For most people, this is the easiest way to save on taxes. It's just a flat amount you get to subtract from your income right off the bat to lower your tax bill. No need to track every single little expense and itemize.
So the good news is, under this new law, the standard deduction is getting a bump for everybody. Doesn't matter if you're single, married, or head of household. For single filers, it's a few $100 more. For married couples and heads of household, it's an even bigger jump. It's basically a simple automatic tax break for most of us. Just to put a number on it, for married couples filing together, that's an extra $700 of their income that they just won't pay taxes on in 2026. Pretty straightforward, right? A nice, simple, automatic tax break. All right, but this law wasn't just about income tax. It also made a really huge change that affects the wealthiest Americans. I'm talking about a major overhaul of the federal estate tax. You know, the tax on the assets you leave behind when you pass away. So here's the headline. The amount you can leave to your heirs without paying a dime in federal estate tax, it's jumping to $15 million per person. So for a married couple, you're looking at passing on up to $30 million completely tax-free, at least at the federal level. That's not just a small change, that is a massive, massive increase. Okay, so let's recap. We've got adjusted tax brackets, a bigger standard deduction for pretty much everyone, and a huge change to the estate tax. When you put all those pieces together, you've got to ask the big question, right? Who really benefits the most from all this? Well, one analysis from the Tax Policy Center suggests that while most folks will see some kind of tax cut, the benefits aren't exactly spread evenly. If you look at it in terms of actual dollars saved, on average, households in the top 20% of earners are projected to see a benefit of over $12,000. For households in the bottom 20%, that average saving is closer to $150.
But there's always another way to slice the data. A different analysis, this one from the Tax Foundation, took a look at the average for a typical filer across the board, all income levels mixed together. And what did they find? An average tax cut of almost $4,000 for 2026. It just goes to show you how different ways of looking at the numbers can paint a very different picture.
And that really brings us to the big takeaway here. This new law uses the word permanent to describe these tax changes, but in Washington, is anything really permanent? The truth is, any law can be changed or even scrapped entirely by a future administration. So while these rules are on the books for 2026, it's a really powerful reminder that when it comes to the tax code, you should probably write the rules in pencil, not pen. Nothing is ever truly set in stone.